The fourth quarter has always been a seasonally weak quarter for the IT industry. Infosys and TCS have already provided a weak margin expectation guidance for this quarter. Additionally, given the rupee appreciation that we've seen in the past month, all of this is going to impact earnings. So what will the fourth quarter look like for key IT companies? Joining us in-house, of course, is Rima. But we've got a special guest joining us, Ashwin Mehta of Nomura, joining in with his expectations. Ashwin, we've gotten some idea of what we should expect on the TCS Infi front, given that they've been very muted and maybe even negative on the Infi end on what to expect from the fourth quarter. What are you building in terms of revenue growth for all of these companies? Dollar revenue growth, sorry.
On an aggregate basis, we are at around 2.3% in terms of sequential growth for the tier 1 IT companies. So that's slightly lower than the last quarter, which was close to 2.7 odd percent. So largely in line with seasonality, a weaker fourth quarter is what we are building in, with Infi TCS being the weaker of the lot, and people like HCL, Techem, Cognizant, and Wipro, we expect them to do close to 3% or higher in terms of growth.
And on the margins front, what would your expectations, Ashwin, be? And would you think that the rupee appreciation would have a material impact?
Not for this quarter, because this quarter the averages are largely similar to what you had last quarter. Rupee would be a factor going forward into 1Q onwards. So this quarter we expect largely moderate declines around 40 to 50 bips across companies, except for maybe Infosys, where we are expecting flattish, or in case of Tech Mahindra, where there are some wage impacts where the declines could be closer to the 100 odd bip levels.
Ashwin, hi, afternoon. Of course, it will all start with Infosys, and this time around what we'll be watching out for Infosys will not just be the Q4 number, but the guidance for next year. Given that Narayan Murthy is back full-time now, what kind of guidance do you expect from Infosys for the next fiscal?
So I think our expectation is for around 6 to 8% growth kind of a guidance for the next year from Infosys. So I think in addition to this, depends on whether they give a much more broader guidance. If it were to be broader and hover around 10% odd at the top end, that might be taken positively in terms of the stock. The other thing to watch out at Infi would be whether the slower growth next year actually leads to any pushback in terms of their margin expectations. So those would be the two things to watch out for Infi.
Hi Ashwin, this is Rima here. TCS has already highlighted over the last few quarters about weak India business. It might impact them in this quarter as well, and perhaps the next one. Which other IT company do you think will get impacted on account of the weak India business?
Wipro also has a large India business, but we don't think Wipro would get impacted because the mix of business at TCS is more government oriented, whereas Wipro is more private sector led. So in case of Wipro, the India business should be strong in this quarter, which is seasonally the case. So we don't see the same replicating at other places given the mix differences.
So you're essentially saying that the weakness in the India business is mostly a TCS phenomenon more than anything else, right? So despite everything that they've said in their commentary in the last few quarters, where they've continuously defended why their India business hasn't done well, this is a persistent pain point, isn't it, Ashwin?
Yeah, so it's largely government-led. So government spending has been soft in India, and it's more the exposure that TCS has to government spending on the IT side, which is what is leading to the muted or actually declines in terms of India business over the last 2 quarters.
Ashwin, we've heard a couple of IT players saying that FY15 is going to be better than FY14. What would your dollar revenue expectations be for the IT majors in the next financial year, FY15? And how much better will it be compared to FY14? Because these stocks have run up on the except in the last 1 month, but have run up on the expectation about next year, things improving because of US, Europe, financial services, digital, etc.
So in terms of our numbers, we are building in a moderately better next year compared to to this year. So we would be close to, I think, 15.5% in terms of growth for the tier 1 IT universe. And in our view, the key differentiator versus last year would be that last year US did not participate in terms of the growth. So US underperformed the overall tier 1 IT growths. We expect that to change going into the next year. So that's something to watch out for in terms of commentaries from these companies as to whether US starts to punch above its weight in the next year.
Ashwin, the big re-rating last year was on Tech Mahindra. Can that continue now that it's a nifty stock as well? We'll be watching out for numbers very closely for Tech Mahindra. But now that the base has moved up, do you think the kind of performance that we have seen from Tech Mahindra can continue?
So I think in terms of Tech Mahindra, we do have a buy on this stock, but we're not necessarily arguing for a material re-rating. I think it's largely an earnings-led story in our view. Near-term traction remains strong in terms of deal flow. That should start to reflect in terms of growth for them, where we think this quarter too they should be comparable or better than the tier 1s in terms of growth. But on multiple re-rating, I think there are still some of the handicaps that they run with in terms of a bigger telecom exposure, which is one segment where you're not seeing a demand surge as such. They have high client exposure. That's another issue. And thirdly, their non-telecom verticals are still smaller compared to their tier 1 competitors. So I would still not argue for a material multiple re-rating, but clearly, given the valuations where it is, we think there is a return to be made here.
What are you expecting, Ashwin, in terms of potential commentary on pricing pressures? In the quarter gone by is, like you said, seasonally weak and expected to be weak, but going forward in the next year?
So I think next year, from a pricing perspective, like-to-like pricing, we don't see a material pressure as such. I think mix in the next year should be better towards some of the discretionary oriented spends, and these spends are typically higher realization spends. So from a pricing perspective, whatever pressures that you see on the commoditized side of business are likely to be compensated by a better mix in terms of growth. So on an overall basis, we don't see CC pricing to be an issue going into the next year.
And in terms of Infosys, the other core concern has been, which is not related necessarily directly to numbers, has been the continuous loss of people. Any conversation with the company that seems to tell you now that that tide is stemmed, in the sense of the outflow is stemmed?
So I think attrition remains an issue, and in our view that might not impact the near term, but their ability to take up allocations from budgets is something that needs to be seen, given the middle level or senior level attrition that they have seen. So that still remains an issue in our view. I think Infi is more, according to us, a margin story than a growth story. And given that they have substantial leverage in terms of improving margins.
Okay. Ashwin, Indian IT, at least the frontline IT, they've underperformed the Nifty by close to about 10%, say in the last 1 month or so. In your conversation with investors who have traditionally invested in Indian IT, have they perhaps exited or trimmed their position in these frontline names, or reduced their holding?
Yeah, I think there has been some shift towards the domestic focused segments, and secondly, there are fears of rupee appreciation beyond the current levels of 60. We think till the current levels of 60, there is not a material risk to earnings. Most of these companies have operating leverages, or they will reprioritize investments to save margins. But beyond that, that remains a headline risk for the sector. So given that backdrop, there has been some shift away from IT.
We seem to have spoken only of large cap IT so far. In the mid cap IT space, Ashwin, what are you looking forward? Who are you looking forward to hearing from?
So in terms of our coverage, we cover Hexaware, we cover iGate, Infosys. are some of the names that we cover. We're not necessarily too positive in terms of these names. So our view is that tier 1 IT should actually outperform tier 2 IT, and typically it's been seen that rupee appreciation risks are much higher in tier 2 IT. Tier 2 IT is at valuation discounts which are narrower compared to historical versus tier 1. And are at peak margins at this point in time. So I would still go with tier 1 over tier 2.
And within tier 1, preferences?
Within tier 1, our top picks are HCL, TCS, followed by Deccan.
All right, Ashwin, appreciate you joining us. Thank you very much for that heads up on what to expect next week.